banks make more money off you when you're poor. Here's a scene that happened roughly 35 million times in America last year. Someone checks their bank account on a Tuesday morning. They bought gas on Sunday, $42. Their balance at the time was $38. They didn't notice. The gas went through anyway. And when they check their phone Tuesday morning, their account doesn't show a declined transaction. It shows a negative balance and a $35 fee sitting right next to a $42 charge. They paid $35 for a $4 mistake. Not 35% interest, not a late penalty. $35 gone for being $4 short on a Sunday. And here's the thing that nobody says out loud. That $35 fee wasn't an accident. It wasn't a glitch. It wasn't a punishment. It was a product designed, tested, priced, and deployed specifically for the moment when you had the least amount of money in your account. The banking system in America doesn't just charge you to use it. It charges you more to use it the less money you have. And it does it across 4 separate layers, each one more expensive than the last, each one targeting the same people, each one completely legal, and almost none of it explained in the brochure they handed you when you opened your account. My name is Nick, and I have spent way too much time reading about financial products that are technically voluntary and functionally inescapable. If you've ever paid a fee you didn't fully understand, or wonder why your friend with more money always seems to pay less for the same things, hit subscribe, because by the end of this video, you'll understand exactly how much the system is charging you for the crime of having a low balance. And more importantly, you'll know how to stop paying it. Let's start with a concept that almost nobody uses in personal finance conversations, but explains basically everything we're about to cover. It's called the poverty premium. Simple version, the less money you have, the more everything costs. Not more in total, more per unit, more per dollar, more as a percentage of what you're spending. Rich people buy in bulk and save. People with less money buy in small amounts and pay retail every time. Rich people pay their credit card balance in full every month and pay 0 interest on it, ever. People carrying a balance pay 24%, 27%, sometimes 30% annually on money they already spent. Rich people own their car outright or finance it at 4%. People with thinner credit files finance the same car at 14% or higher. Same economy, same product, completely different price tags. And the price tag is determined almost entirely by how much money you had to begin with. And the structure runs deeper than most people realize. It's not just credit cards and car loans. The poverty premium shows up in your checking account, your insurance premium, your utility deposit, and a parallel financial universe that roughly 19 million Americans use every single day because the mainstream banking system either rejected them or made itself too expensive to use. We're going to go through all 4 layers today. And I'll tell you up front, the 4th one is the quietest and probably the most expensive one per year. This isn't a glitch. It's the architecture. And once you see it, you can't unsee it. Layer 1, overdraft fees. You already know the scene, but let's look at the actual numbers because most people have no idea how large this machine really is. American banks collected approximately $7.7 billion in overdraft and non-sufficient funds fees in a single recent year. Not from hedge funds, not from corporate accounts, from personal checking accounts, from regular people who were a few dollars short at the wrong moment. One study found that 9% of account holders, the ones with the lowest average balances, paid 84% of all overdraft fees collected. Read that again. 9% of customers generated 84% of the revenue from this one product. The fee isn't random, it's targeted. The system is designed to maximize collection from the people least able to absorb it. Here's how overdraft coverage actually works. You have $38. You spend $42. Instead of declining the charge, which would be free, instant, and would involve a mildly embarrassing buzz on your phone at the gas pump, many banks cover it and charge you $35 for the service of covering it. Some banks charge the fee multiple times per day, up to 6 or 7 times. If you're running a low balance and make 3 small transactions while overdrawn, a coffee, a fast food order, a convenience store, that's $105 in fees on what might have been $15 in purchases. Your bank just made 7 times the money on that transaction than the merchant did. And here's the detail that should genuinely change how you see this product. Banks fought for years against regulations that would have required them to simply decline transactions instead of approving and charging. They lobbied, they produced research arguing that customers preferred coverage to declines. They won, mostly. The CFPB has moved to cap fees at around $5 per incident, and that rule is working through the regulatory process. Some major banks have voluntarily eliminated overdraft fees entirely. Capital One, Ally, Citibank.
but many haven't. And the ones still charging $35 per incident are disproportionately serving the lower-income customers who had the fewest alternatives and the least leverage to complain. Layer 2. Credit scores as a pricing machine. Most people think of a credit score as a report card, a judgment on how responsible you've been with money, a financial grade. But that framing is slightly off, and the difference matters. A credit score is a pricing tool. It exists so that lenders can charge different amounts to different people for the exact same product. And the inputs that determine your score are, in many ways, circular in a way that disproportionately affects people starting with less.
Here's what I mean. To build a good credit score, you need a history of using credit responsibly. To get a history of using credit, you need someone to extend credit to you. To get someone to extend credit when you have no history, you need either a cosigner, a secured card that requires a cash deposit you may not have, or a high-interest starter product designed for people with no history. You build credit by using credit. You get better credit offers by already having had credit. If you're starting with nothing, the first rung of the ladder costs money to reach. And the penalty for a low score isn't just that you can't get a loan. The penalty shows up on everything you do financially for years. Take car loans. If your credit score is 760, solid, not exceptional, you might finance a $25,000 car at around 5% interest over 60 months. If your score is 580, you're looking at 14% or higher on the same car from the same dealership on the same day. Run the math. At 5%, you pay roughly $3,300 in total interest over the life of the loan. At 14%, you pay over $10,000. That's a $6,700 difference for the same vehicle. The only variable is a 3-digit number that partially reflects whether you had enough financial stability early in your adult life to use credit products in the way the formula rewards. Mortgages are worse. The difference between a 640 credit score and a 760 on a $300,000 30-year mortgage can easily be a full percentage point on your rate. That single point, compounded over 30 years, adds up to over $60,000 in additional interest payments. $60,000 more for the same house, the same neighborhood, the same loan amount, because you didn't have enough financial runway early enough to build the score that earns the lower rate. And it doesn't stop at lending. Credit scores are used to price auto insurance in 47 states. Landlords use them to screen rental applications. Utility companies use them to determine whether you pay a deposit before they'll turn on your electricity. In some states, employers use them in hiring decisions for certain roles. The score that was originally designed to help lenders assess default risk has expanded into a general-purpose pricing mechanism for your entire financial life. And it rewards, structurally and mathematically, people who were already stable enough to use it well. Layer 3. The shadow banking system. Most people with healthy checking accounts and solid credit scores have never walked into a payday lender or a check cashing store. They exist in a different financial universe. But for roughly 5.9 million American households classified by the FDIC as completely unbanked, and tens of millions more who are underranked, meaning they have an account but regularly use alternative financial services, there is an entirely parallel system, and it is extraordinarily expensive to use. Let's start with payday loans, because the math is genuinely staggering once you run it out.
You need $300 to cover rent before your next paycheck hits in 2 weeks. You go to a payday lender, they give you $300. In 2 weeks, when your paycheck arrives, you pay back $345. That $45 fee on a 2-week $300 loan, which feels manageable in the moment, works out to an annual percentage rate of approximately 391%. Not 39%, 391%. A credit card, which most financial advisors consider an expensive form of consumer credit, charges between 20 and 30% annually. A payday loan can charge 10 times that. And the people using them aren't doing it because they failed to read the fine print. They're doing it because the overdraft fee was already $35. The credit score is too low to qualify for a personal loan, and the landlord doesn't accept, "I'll have it in 2 weeks." The payday lending industry in the United States generates roughly $9 billion in fee revenue per year, and research consistently shows that the majority of that revenue doesn't come from first-time users who borrow once and pay it back. It comes from repeat borrowers, people who roll the loan over, extending it for another fee because they still can't cover the original amount plus interest on their next paycheck either.
The one-time $45 fee doesn't always stay a one-time fee. In many cases, it becomes a recurring charge of $45 every 2 weeks for months. That adds up to about $1,170 in a single year on a loan of only $300. At that point, it is no longer just a financing cost. It becomes a cycle of ongoing debt. Check cashing services work differently, but the costs can add up just as quickly. If you don't have a bank account, you usually can't deposit a check. Instead, you have to cash it at a check cashing store. These businesses often charge between 1% and 3% of the check's value. On a paycheck of $1,200, that means paying anywhere from $12 to $36 just to receive money you have already earned. If you are paid every 2 weeks and pay a 2% check cashing fee each time, those charges can total around $624 over the course of a year. You are not paying to borrow money or earn interest. You are simply paying to access your own paycheck. A basic checking account, including those offered through bank-on certified financial institutions, can often be opened at little or no cost and usually takes only a short time to set up. However, opening an account may require a government-issued photo ID, proof of address, and in some cases a social security number. Some banks also review a customer's check systems record, which tracks previous banking history. If a past account was closed because of repeated overdrafts or other issues, that record may make it harder to qualify for a new account. For many people, leaving the alternative financial system is possible, but the path is not always simple. The opportunity exists, yet practical barriers can make it difficult to take the first step.
Layer 4, the invisible cash premium. This is the one nobody puts in the brochure, and it might be the most quietly expensive layer of all. Here's the question. If you only use cash, no credit cards, no rewards programs, no digital payment systems, are you sidestepping the financial system and all its fees? Not exactly. You're avoiding some fees, but you're also forfeiting something, and the forfeit is real money. Rewards credit cards, the kind that give you 1.5% to 2% cash back, are essentially a transfer of value from merchants and card networks to cardholders who pay their balance in full. The merchant pays a processing fee on every transaction. A portion of that fee flows back to the cardholder as rewards. If you pay cash, the merchant still built that processing cost into the price because they have to cover it for all the customers who do use cards. You paid the same price but collected none of the rebate. On $30,000 of annual spending, a 1.5% cashback card returns $450 per year. A 2% card returns $600. These aren't huge numbers, but they're consistent, they're annual, and they're available to anyone who uses the card and pays it off. If you're paying cash, that money doesn't exist for you. It exists for someone else.
Car insurance. Most states allow insurers to use credit scores as a pricing factor independent of your actual driving record. You could have 0 accidents and 0 claims for 5 years running. If your credit score is poor, your premium can still be significantly higher than a driver with an identical record and better credit. One Consumer Reports analysis found that drivers with poor credit paid an average of 76% more for full coverage auto insurance than drivers with excellent credit, holding all other factors equal. 76%. On your insurance premium, which is also required by law for you to drive. And then there are the deposits. Utility companies in most states can require a security deposit from customers with low credit scores before activating service, typically $100 to $300 per utility. That money sits with the utility company, sometimes for a year or more, earns them interest, and comes back to you eventually with 0 compensation for the float they got to use. It's a small number per household. Nationally, it adds up to billions of dollars per year in interest-free capital that low-income households are involuntarily extending to utility companies.
Apartment applications, rental applications, phone contracts on postpaid plans. All of these run credit checks, and all of them have tiered outcomes based on score. More deposits, higher security requirements, fewer options. In some cases, outright rejection that redirects you to higher cost alternatives. Prepaid phone plans, furnished sublets with premium rents, hotels as temporary housing. The cash premium is not one fee. It is a slow, structural tax on every financial interaction you have, charged not at a visible checkout line, but invisibly, in the gap between the price you pay and the price you could have paid if the score was different. And it compounds. Every year you spend in this layer is another year of higher insurance, higher deposits, more limited rental options, and rewards you're not collecting. Here's the reframe. And this is the part that most finance content skips because it's less emotionally satisfying than having someone to be angry at. Banks are not evil. They are optimizing. Every product we covered today, overdraft coverage, tiered credit pricing, payday lending, check cashing fees, credit-based insurance pricing, exists because a team of analysts ran the numbers and found a profitable pattern. Banks charge $35 overdraft fees because the customers being charged are not, in large numbers, closing their accounts over it. They're absorbing it. Payday lenders charge 391% APR because their customers have no alternative that's faster. Insurance companies use credit scores because the actuarial data supports a correlation with claims risk, even if the causality isn't clean.
None of it requires malice. All of it requires indifference. The system charges what people will pay, it charges more to people with fewer options, and it is entirely legal. Understanding this is more useful than being angry about it, because once you see it as a rational, optimizing machine rather than a villain, you can make specific decisions that route around it rather than waiting for someone to change it on your behalf. Quick pause here. If this is making things click for you, hit the like button. It takes 1 second, it's free, and it tells the algorithm that people actually want to understand how money works. Okay, let's talk about what you can do right now. Practical move 1, turn off overdraft protection today. Go into your bank app or call the number on the back of your card and disable overdraft coverage. Yes, some transactions will decline. That is the intended outcome. A declined transaction costs you nothing and produces a mildly awkward moment. An overdraft fee costs you $35 and produces a mildly awkward moment plus $35 less in your account. Better move, switch to a bank that has eliminated overdraft fees entirely. Ally Bank, Chime, and many local credit unions have done this. Your existing bank is counting on the friction of switching to keep collecting. Switching takes about 45 minutes. Practical move 2, build your credit score without carrying a balance.
The myth that you need to carry a balance to build credit is false and costs people real money. What the scoring formula actually rewards is on-time payment history, which accounts for 35% of your score, and credit utilization, keeping your usage below 30% of your available limit, which accounts for another 30%. If you have no credit history, open a secured card, deposit $200 to $500, use it for one recurring small purchase per month, a streaming service, a utility bill, pay the full balance every month automatically. After 12 months, you have a score. After 24, you have enough history to qualify for unsecured products with better terms. If you have damaged credit, same process. Small purchases, full payment, automated. The score is a formula. The formula is public. There is no trick. There is only consistent input over time. Practical move 3, never use a payday loan. I understand that is easy to say from a position of financial stability and harder to follow when you genuinely need $300 before Friday. So here are the actual alternatives in ascending order of friction. Federal credit unions offer payday alternative loans, PALs, capped by law at 28% APR. That is 1/10 the cost of a standard payday loan. You need to be a credit union member, but membership is free or costs $5 to $25 to join. You can apply before you need the loan. Many employers will advance wages against hours already worked. It feels uncomfortable to ask. The math says ask anyway.
If you're facing a financial emergency, you don't have to handle it alone. Many nonprofit credit counseling organizations offer emergency assistance or can connect you with local community programs designed to help people in situations like yours. You can also visit 211.org to find available resources and support services in your area. Another helpful option is a credit card with a 0% introductory APR. If your credit score qualifies, these cards can provide interest-free financing for 12 to 18 months. The key is to apply before an emergency happens, not after. If you're currently building your credit, consider getting one now so it's available when you need it most. Practical move 5, open a free bank on checking account. If you don't currently have a bank account or you rely on check cashing services, opening a free checking account could be one of the most valuable financial decisions you make. The Bank On program, supported by the FDIC and the Cities for Financial Empowerment Fund, works with participating financial institutions to offer safe and affordable checking accounts. These certified accounts typically have no minimum balance requirement, no overdraft fees, and little to no monthly maintenance cost. You can find a complete list of participating institutions at joinbankon.org. Opening an account usually takes about 20 minutes. If you're currently paying a 2% fee to cash a $1,200 paycheck every 2 weeks, switching to a free checking account could save you approximately $624 over the course of a year. That's an impressive return for a small investment of your time. Practical move 5, use a strong credit score to lower your insurance costs. A healthy credit score doesn't just make it easier to borrow money. In many cases, it can also help you qualify for lower insurance premiums, reducing your long-term expenses and strengthening your overall financial position.
In 9 states, California, Hawaii, Massachusetts, Michigan, Maryland, Oregon, Utah, Nevada, and Washington, insurers are banned or significantly restricted from using credit scores in auto insurance pricing. If you live in one of those states, your record matters more than your score for your premium. If you live anywhere else, improving your credit score will lower your auto insurance cost, often significantly, even without filing a single claim or changing your vehicle. Once your score crosses key thresholds, 640, then 700, then 740, shop your insurance again. The premium that was priced off your old score is now overcharging you. Get new quotes. The system that used your score against you will use it in your favor the moment the number changes.
Here's the thing. Nobody hands you a price list when you open a bank account. Nobody explains that the balance you carry determines the fee structure you live under. Nobody tells you that the same car, the same house, the same insurance policy will cost you more or less based on a 3-digit score that measures not just your behavior, but the financial circumstances you started in. You opened that account because you needed somewhere to put your money. You didn't sign a contract agreeing to pay $35 for a $4 mistake. You didn't ask for a tiered pricing system that charges you more for the same products as your higher balance neighbor. You didn't opt into a parallel financial universe where accessing your own paycheck costs 2% every 2 weeks.
You were already inside the system. You just didn't have the price list. The poverty premium is real. It is legal. It is worth tens of billions of dollars per year to the institutions collecting it, and almost none of it is accidental. Each layer was designed, tested, and maintained because it extracts money from people with the fewest alternatives and the least leverage to push back. But it only works on people who don't know it's there. You know it's there now, and you have 5 specific moves, none of which cost money, all of which take an afternoon, that chip away at every layer of it. Turn off overdraft, build credit without a balance, skip the payday lender, open the bank on account, let the improving score reprice your insurance. The banks will be fine. They'll find other optimizations. But that $35 fee for a $4 mistake?